Hi, everyone. Thank you for joining us. We're excited to welcome Lyn Alden Schwartzer, who is the founder of Lyn Alden Investment Strategy and is a contributing analyst to ElliottWaveTrader.net, covering equities and alternative investments. Lyn, thank you for joining us. The floor is yours.
Happy to be here and welcome everyone. So my presentation is going to focus on S&P 500 valuations, and we're going to look at it from a couple different perspectives. Basically what I'm going to show is that how challenging of a market this is compared to some other highly valued periods and compared to some low valued periods. So let's dive right into some of these, ways of looking at it. Before we get into the 5 ways I'm going to look at it, I want to kind of set the stage for kind of why this is like this. And so this is the 3-month Treasury bill year-over-year CPI change. And so basically, it's the inflation-adjusted rate that you earn on T-bills, and that's also a good proxy for other cash equivalents like money in the bank. And so generally, what you see over the long period of time is it has not been a particularly good investment. It's mostly just kind of treaded water with inflation. But there were some decades where it's been particularly bad. And so the later half of the 1930s, throughout the entire 1940s, the 70s, and then the 2010s were all rather bad times to be holding cash equivalents compared to other types of assets. That's kind of what's pushing a lot of people out on the risk spectrum, of course, is that because cash is not even keeping up with inflation, they're forced to go into other types of investments. And that has the risk of causing bubbles or high valuations in some of those other asset classes that can then drive down their forward returns. The second piece I would look at in terms of where we are is the long-term debt cycle. And so this was a topic popularized by Ray Dalio over the past decade. And basically the idea is that, you have the 5 to 10 year business cycle where leverage builds up in the system and then gets partially deleveraged at the end of every cycle when there's a recession or some sort of external catalyst. But that when you string multiple of those together, you keep getting higher and higher debt levels and you get lower and lower interest rates. And so what I have here on the left chart is the orange line is private, non-federal debt as a percentage of GDP. So it's mostly private debt. That's corporate debt, that's household debt, a little bit of state debt. And so that's basically, you see these 2 periods where you had these big giant private debt bubble unwinds, and those were major banking crises. And then, last time what we saw was that as this ground down, basically they transferred a lot of that debt to the federal balance sheet. Of course, a lot of this was for World War II, but essentially what that did, that was a very inflationary fiscal driven response. And it actually partially deleveraged this bubble because you were inflating away big chunks of that debt. And so, we've already kind of crossed that similar outcome here. And now we're in this more fiscal driven inflationary environment that is, likely to be bad for cash like assets and pretty good for more scarce assets as long as you don't get caught up in valuation problems. And this is another way of looking at it. So the orange line is the short-term interest rate, and you can see the ports where it hits the zero bound. That of course occurred during these 2 banking crises. This is the monetary base as a percentage of GDP in blue, right? So that's quantitative easing and other types of measures that the Federal Reserve can do to increase the monetary base. And then those gray lines are the federal deficits as a percentage of GDP. And so, the analogy I often use is that the 2010s were a lot like the 1930s, and the 2020s are shaping up to be a lot like the 1940s in terms of fiscal and monetary policy. And so, of course, this was a rather, the first half of the 30s were a very deflationary environment. By the end, it was a little bit more inflationary, not too much, but it's really in the 40s where you got that more inflationary environment because you had that fiscal driven inflation happening. And we're seeing this similar thing play out, hopefully not at the same magnitude, but kind of directionally similar. And so with that as a backdrop, we can dive into equity valuation to see what we're working with here in terms of how we want to position for this coming longer term period. Because when you talk about valuations can't tell you what's going to happen with stocks in a 3-month period or even a 12-month period. It's really about what's going to happen in a 5 to 10 year period. It's basically how do you want to be positioned in a tax advantaged way into different types of asset classes. And so one metric we can look at is the market capitalization of the broad stock market, which is over 80% the S&P 500, compared to things like GDP or broad money supply. And so a big metric that's been making its way around is that if you look at the blue line here, that's the stock market as a percentage of the U.S. GDP. We're at all-time highs, and so we're higher than we were at the dot-com bubble, way higher than the 2007 high, and then way higher than these very cheap equity periods of the 70s and 80s. And so by that metric, we've really never been more expensive. Similarly, if you look at things like price of sales, that some of those other metrics also show that we're at all-time record highs. The red line here is the stock market as a percentage of broad money supply, M2. And so what we see there is actually we're somewhat average, a little bit elevated compared to history. So, the highest we've reached there was the dot-com bubble. Right now, we're back up to where we were towards the top of this cycle. Obviously, we're way higher than we were during this cheap equity period. We're way higher than we were during these recession bottoms. And so by that metric, it's concerning. It's less frightening than the GDP statistic. But it just shows that, basically we've had a lot more money supply growth than we've had GDP over the past 20 years. And so we've had some divergence in these two types of valuation measures. And it's something to keep aware of. When there's so much money out there chasing assets, it naturally tends to push those assets up. The other way of looking at it is the popular cyclically adjusted price to earnings ratio. And actually, my title there is kind of redundant, I just realized. So cyclically adjusted price to earnings ratio, known as the CAPE ratio. And that is Professor Robert Shiller's metric. And what that does is, instead of look at the current price to earnings ratio, that compares the current price to the inflation adjusted average of the last 10 years worth of earnings. And basically what it does is compares the price to kind of a full business cycle worth of earnings for either a stock, or it can be applied to the broad market in this case. And so this is the cyclically adjusted price to earnings ratio for the S&P 500 equivalent. So the actual index has not been around this long, but it's basically of the top 500 companies as defined by either S&P or Shiller's research for some of the older periods. And what this shows is that by this particular metric, we're the second most expensive we ever were after the dot-com bubble, with a CAPE ratio of about 37. It's higher than 1929. It's higher than most other periods in history. And so this is again another rather concerning metric by most valuation metrics. This basically, there's a good correlation between this metric and how well stocks do over the next 10 years. And so generally, when you get to periods like this or this or this, the forward returns over the next decade were rather abysmal. And so by that particular way of looking at it, the forward returns from this point, or even from this point, when you stretch it out to the past 10 years, then the next 10 years are unlikely to be good unless, quote unquote, this time is different. This is a slightly more sophisticated version of Shiller's CAPE ratio. And what this shows is the cyclically adjusted earnings yield. So it's basically the inverse CAPE price to earnings ratio. So earnings divided by price, but then those earnings are cyclically adjusted. And then they're comparing that to the 10-year treasury yield. So you're saying, okay, stocks don't exist in a vacuum, right? Because you can also buy bonds or other assets. And so this, it's not comparing how stocks do, it's comparing how well they do versus bonds, which is the primary alternative. And so what you generally see here, so the blue line is the excess CAPE yield. So the higher it is, the cheaper stocks are relative to bonds. Basically, mean you can get a lot of earnings for every dollar you put into the equity market compared to the 10-year treasury. And so generally, buying in the early 20s, buying in the 50s, buying in the early 80s, buying in 2009, those are of course very good times to be buying into the equity market, because you're getting such a good deal compared to the bond market. On the other hand, there were periods of time where, in 1929, in the late 60s, in 2000, where you had very, very bad equity valuations compared to what you could get with the bond market. And the 2000s were a great example, because the CAPE ratio was as high as it ever was, while bond yields were still like 6% on a 10-year treasury. And so it was a no-brainer to move into treasuries. And in fact, you had pretty much the biggest ever performance gap of the next 10 years, where basically the green line is how well stocks did compared to bonds over the next 10 years. And so generally what you saw is during these low points, usually stocks did quite poor compared to bonds. And so, for example, it was much better to buy 10-year treasuries at the top of the dot-com bubble, unsurprisingly, compared to equities. And so, but what we see here is that we're actually kind of moderate based on this metric. And that's because bond yields are so low, and that bond forward returns are going to be so low, that even these rather high CAPE ratios don't necessarily say that stocks are going to underperform bonds. And so that's part of what makes this environment so challenging, is that as expensive as stocks are, so are bonds. Whereas in this environment, and to a lesser extent this environment, you had a much better alternative in buying a 10-year treasury that could offer you a positive real rate of return. And so this metric shows why it's not necessarily a clear-cut case of overvaluation or undervaluation. Another way of looking at it, rather than valuations, is the level of speculation in the markets. And so this is two ways of looking at margin debt. So we have advisor perspectives and we have Yardney. And so this shows the S&P 500 in blue. It shows margin debt in red, and basically have a pro-cyclical correlation. So during market tops, there's more leverage in the system. Then they get forced to deleverage at bad prices. And so generally, what we see is that we had tons of debt before this kind of current consolidation period. We cleared some of that debt out, but then in the big recovery, as stocks went up, we also had a lot of margin debt. And another way that you can look at that is with this chart on the right, where you're looking at the year-over-year change, percent change in margin debt, because it's not necessarily the level that dictates timing. Basically, the rate of change can be rather informative. And so, by that metric, we hit very, very high year-over-year change in margin debt, indicating a big speculative bullish increase by the market, which tends to be a somewhat counter-cyclical measure. And so basically, if you compare that to other high margin periods, or I should say high change in margin periods, those tend to correlate with these peaks as well. That tended not to be a great time to be invested in equities. Now, there are, however, some uh, false alarms. And so, for example, you can have this period where you just had, a big fall, and then you kind of have like a initial recovery. Same thing with the mid 90s. So, no one metric is highly informative, but they kind of come together to form a narrative. And then the last way of looking at it is with individual stocks. And so, of course, the S&P 500 is a collection of 500 different companies, and regardless of what happens over the next decade, there will certainly be ones that do well and ones that do poorly. And so rather than just trying to figure out what the entire market does, the question is there certain types of sectors or certain types of assets we should maybe consider if we're concerned about the broad S&P 500. In addition, looking at individual companies can tell us, to some extent, what the S&P 500 is going to do. We can look at the top 5, 10 companies. We can look at some of the smaller companies in there and get an idea of what individual stock valuations look like and what some of their big opportunities and risks are. And so what I have here is an example of a value stock and a growth stock. And so on the left here, we have Bristol Myers Squibb. It's a kind of an older pharmaceutical company. They're rather diversified. They pay a dividend. And they acquired Celgene, a couple years ago, and so they greatly expanded their drug pipeline. So they have what is considered one of the strongest pipelines in the pharmaceutical sector. They did take on a substantial amount of debt by that, but they also increased their cash flows. And so now they're going through a period of consolidation, deleveraging, as they, hopefully ingest that acquisition well. So far, it's been going well. And what we generally see is that, this was a rather poor performing stock over the past several years. They had a really, really good run with the rest of the healthcare sector. But ever since that 2015 period, the last 5, 6 years, the overall healthcare sector has not been a very good performing sector, and this one's been no exception. And so they've stagnated, even though their earnings have gone up, and that's partially because they were overvalued, so earnings kind of caught up to the stock price. But now what we see is that we're seeing this big increase in earnings, and then the acquisitions also adding more earnings, while the stock price is languishing. And so for people that are not familiar, these are called fast graphs. It's a company called Fast Graph that I think they do great work. And so the black line is stock price. And the blue and the orange lines essentially represent what the stock price would be if it were trading at its historically average valuation. And so the blue line is what it would be at if it was at its average 20-year price to earnings ratio, and the orange line is what it would be if it was at a 15 price to earnings ratio. And what this essentially shows is that by most metrics, for example, this stock is undervalued. And that doesn't necessarily mean it'll do well over the next 10 years. There could be all sorts of tail risks related to regulatory action, related to problems with their drug pipeline. There are a number of tail risks that could happen. But essentially what we're looking at here is a company with rising earnings, a price to earnings ratio that is roughly 10, a little bit below 10, that pays a nearly 3% dividend yield that's well covered by earnings. They have a high credit rating, and they're going through a process of absorbing an acquisition and deleveraging. And so this is something where we can look at the overall stock market, and yet we see examples like this. It's a member of the S&P 500, and it's very cheap. On the other hand, we have on the right there, that's Cadence Design Systems. They design software that engineers use to design electrical circuits and computer systems. And so obviously that's a very, very strong industry to be in. This is the leader in their particular niche in most cases. I've personally used their product in the past because my background is partially comes from the engineering perspective. And so, what this stock shows is that the overall growth has been pretty good. I mean, this is a mature company. It's not one of those hyper growth new companies. This has been around for a while. We can see they ran into some cyclical issues like many other companies during the recession. Actually, unlike this pharmaceutical company over here, they actually had more of an issue. But one thing that we've seen in the software industry is that we've seen a shift towards one-time product sales versus software as a service, recurring subscriptions, which is a much better business model. And so it was during this time period and over the past 4 to 5 years that they were able to ramp up their growth rate to some extent because they converted a lot of their one-time sales into ongoing memberships. So they've really strengthened their business over this time. The market assigned a valuation premium to that. They started to basically value the company higher, which makes sense to a certain level. The problem is, eventually they get to a point where they reach a new steady state where they transition towards that subscription model, and it's really hard to kind of get more and more valuation boost from that. And so then what we saw in 2020 is that because of the pandemic, because of the market kind of flooded into tech stocks and stay-at-home stocks, plus all that fiscal stimulus, the stock price went absolutely vertical. Even though the fundamentals, they did fine. I mean, they're doing great, but the stock price really went vertical. And so this is kind of an example of an overvalued company, by most metrics. So it's got a price to earnings ratio in the mid 40s, even though the expected analyst consensus earnings growth is high single digits, probably low double digits. So kind of a moderate growth company, and yet it's trading at a rather high valuation. Does not pay a dividend, even though it's a very mature company. And so what we generally see is that, if you look at, if you were to do this 100 times over and look at 100 value stocks, 100, classically growth stocks, what you'll generally see is that many value stocks are actually trading at average or even below average valuations, while many growth stocks are trading at average or above average valuations. And so we're seeing kind of a little bit of a rotation happening here, where we're seeing some recent strong performance of the value space, and we've been seeing more pressure on some of these growth names. Another way of looking at this is the growth to value ratio. And so what this line shows is the Russell 1000 value total return index divided by the Russell 1000 growth total return index. And so what that does, that looks at the largest 1000 companies. Again, most of that is weighted into the S&P 500, the top 500. So generally, whenever this line is going up, it means that value stocks are outperforming in a broad sense. So lower valuation stocks are generally outperforming. That includes generally banks, energy, healthcare, utilities, things like that. Whenever the line's going down, it means growth stocks are outperforming. So that often includes tech stocks as the key example, but also many consumer discretionary companies, and some fintechs and things like that. And so what we've generally seen is you've seen this kind of big multi-year rotations in terms of which factors are doing well. And so, in the 80s, you had value stocks do quite well. In the 90s, during the whole internet boom leading up to the dot-com bubble, you had a massive outperformance of growth equities. And then as that unwound, then you had the real estate and banking bubble. So that was a bubble in the value space. You had a massive outperformance in value. And then when that all blew up, you started to get a big outperformance in growth equities that really kind of accelerated during the pandemic, because all the value stocks were the ones that were disrupted, while the stay-at-home tech growth stocks, they either were unharmed or in many cases improved. And so that was a huge performance gap similar to 2000. And ever since the vaccine announcements and some of this fiscal stimulus has come online, we've actually seen somewhat of a rotation back where value stocks have been outperforming their more growth-oriented peers. And so my overall base case is there's a good reason to expect that to continue to at least to some extent. I don't think we're gonna see a massive rise up here, but I do think that this could normalize for a number of years. Where if you go back to that previous slide, basically what you're seeing is that these types of stocks are rolling up. These types of stocks are maybe consolidating, running into issues, and therefore you get the value factor outperforms the growth factor for a period of time. And so if we kind of put all these pieces together, what we generally see is that stocks by most metrics are quite expensive in absolute terms. They're either the most expensive they've ever been based on some things like the market cap to GDP ratio or the price to sales ratio, whereas in other metrics, they're quote unquote only the second most expensive they've ever been, like the CAPE ratio and some of those other types of metrics. And so by any way of looking at it, stocks are very expensive in absolute terms. However, they're not necessarily expensive versus bonds. They're roughly average compared to how they compare to the bond market. And basically what that's telling us is that, both stocks and bonds are arguably overvalued in the sense that they're both of those asset classes are likely to provide low forward returns going forward. And therefore there could be alternatives like specific sectors or commodities or foreign markets or things like that that can potentially provide alpha compared to these more traditional asset classes. And then three, that within that context of stocks and bonds both being expensive, many value stocks are arguably not expensive at all. And of course, that comes down to analyzing the risk that things will be value traps, right? So we have, basically when you're analyzing something like this, you're weighing the probability that the analysts will be wrong about the forward earnings potential, that they will run into some sort of tail risks and their earnings will roll over and the stock price will never be allowed to kind of catch up. And so there are a lot of things like banks or energy companies or pharmaceutical companies where they're rather cheap on a historic basis, or at least some of them are like banks are maybe average on a historical basis. But compared to the broad stock market, they're providing good dividend yields. They have reasonable earnings growth, and they're actually in many ways improving their business over the past 5 years. And so the market is kind of ignoring that space still, even though recently it has started to catch on. We still see these rather large gaps between prices and fundamentals as measured by these blue and orange lines in the green areas. And so overall, I think that the takeaway here is that whether something's expensive, partially depends on what you're looking at, how you're measuring it, what you're comparing it to. And I think under the surface, there is opportunity there for investors that are willing to kind of rotate into some of the things that have maybe not done well over the past 5 years. And so that'll kind of wrap up my core presentation, but I'm happy to answer any questions that come up.
All right. Thank you, Lyn. That was a great presentation. We really appreciate your time today. So the first question, I was wondering if it's time to invest in treasury bonds via such products as TLT. What do you think?
So going back to this chart, it compares stocks to bonds. And this is the 10-year, so the TLT is a little bit longer than that. But overall, what we're generally seeing is that if you look over the very, very long term, there's still a good chance that stocks will outperform bonds from current levels. And I think there's even a higher chance if you then look at maybe the value side of equities that they're likely to outperform bonds. And so overall, I'm much more interested in the value equity space than I would be in terms of bonds. Now, if we look at shorter term, I think that if we look at inflationary pressures, so we just saw a rather high inflationary print for April, which was reported in mid-May. So that came in at like 4.16%. And if you look at the base effects, we're likely to see even higher numbers reported for the May period, which will come out in mid-June. I think we're probably going to hit 4.5% easily. There's a decent chance we hit 5% year-over-year inflation. But then as you go into the second half of the year, those base effects start going away, and we're likely to roll over a little bit, at least in terms of rate of change of inflation. And so I do think that there could be a time to tactically buy bonds if you're worried about, for example, this margin sentiment here. I do think that there's a case where bonds could outperform stocks over the next year or so. And so I do think that they can have a role in a portfolio. I'd maybe would look out a month or two and to see some of these inflation numbers start to roll over before I'd maybe get more interested in bonds. But that overall, I don't particularly like bonds for the long term here, even though they can be useful tactical moves.
All right, thank you. Curious if you have any thoughts on sector discrepancies and or the total dominance of FANG Tesla, i.e. energy is near record low valuations, industrial is also low, but a handful of big names are skewing average valuations way higher.
So I do, and so my overall case is that I think we're going to see a period of mean reversion, which we're starting to see play out. And I think that charts like this show that I think there's still quite a bit of room to go in terms of that mean reversion. That the FANG stocks generally look more like this chart, whereas the energy stocks, they don't look as clean as this chart because energy's been very volatile lately. But in general, I think that you're likely to have some of those more cyclical or value-oriented sectors continue to do well with maybe a 5-year perspective. That I think that there's still a good runway ahead for some of this rotation to continue. Now, a lot of the FANG stocks don't look this bad. So really, a lot of the really kind of valuation bubbles are happening in the unprofitable speculative tech space, where some of those really large profitable ones, if you look at Apple, for example, you'll see, they generally look like this. They had a similar kind of big differential where they kind of got too expensive. Google, Microsoft, they didn't have quite this big of a divergence, but like their black line is kind of like up here, like you wouldn't be surprised to see it kind of flatten or kind of roll out as earnings continue to catch up. Amazon is actually about historically average valued compared to its normal metrics. And generally, Amazon's kind of a weird one because it trades more based on operational cash flows and earnings compared to some of these other equities. But based on a price to cash flow ratio, they're at about average compared to Amazon's history. And so I do think that there are uh, uh, some attractive stocks in that space. Like I'm reasonably bullish on Amazon and Facebook with say a 5-year view, for example, where I'd be more concerned about the Apples and the Microsofts that I think are maybe a little bit ahead of themselves. But that it's really in some of those unprofitable tech that I'm concerned about. Same thing if you look at say Visa or Mastercard, they're now kind of in that big FANG grouping almost because there's such large weights in the S&P 500, and they've had very strong momentum and growth. And again, many of them look more like Cadence here, where their fundamentals are great, but their stock prices are in many ways quite stretched. And so I do think that this rotation has some legs to it before we have to start kind of being really concerned about rolling over. Now, if I were to zoom in here, there were month or two periods where growth went back to outperforming. So if I were to zoom in there, there'd be zig and zags, and I think we're going to see that again. I think we're going to see these periods where growth starts outperforming again, but I do think that the overall kind of zigzag of this is probably up if I were to continue to monitor this based on valuation differentials and the cyclical recovery that we're going through.
Thank you. What would you recommend as an investment at this stage?
So I like value stocks. I like pharmaceutical companies. I like some of the higher quality energy stocks. So I'm wary of the really low quality stuff. But the companies that were generally more disciplined with their balance sheet, with their cost of production, I do like some of the oil stocks. I also like some of the energy pipelines. They've really de-risked over the past 5 years. Where they become more self-funding, they're less reliant on external capital, and so they can provide high yields they're much safer than they used to be, especially again if you stick to the higher echelon of quality in that space. I do generally like a good chunk of international equities, and so we've seen, for example, Japanese value equities are actually pretty attractively priced at the current time. In many cases, they're priced roughly at book value, and they're profitable dividend-paying businesses. Many of them have international exposure, so they're not purely tied to Japan's economic growth. I've also actually liked, for example, Russian equities. They've been very cheap, and even though there are some jurisdictional risks, generally there are some rather well managed Russian large caps. And so basically, my overall approach is I'm bullish on commodities. I'm generally bullish on the value sector. I'm generally moderately bullish on international, but with a country by country basis. I also like gold as maybe a 5% position in portfolio to replace some of the bond component. I'm generally somewhat bullish on gold and actually gold miners in particular, because even if gold were to stay at current prices, many gold miners are extremely profitable at current gold prices and trading at very normal valuations, very attractive valuations. And so if you look at, for example, back in 2012, when gold had that big bull run, gold miners managed somehow to not be profitable during that time. They didn't generate free cash flow, despite the fact that gold went from like 300 to like 1900 an ounce. They managed to not really be profitable. Whereas what we're seeing in this time is that during this big uh, uh, bull run in gold and then the recent correction and kind of rebound, that they've been very disciplined. And so basically all that higher gold price, they've been using it to deleverage their balance sheets and generate free cash flow and pay dividends. And so actually the gold miner space is pretty attractive. And so my overall approach is value stocks, international stocks, and some commodity oriented exposures.
All right, thank you. What are your thoughts on the real estate market?
So that's a very zip code dependent market, and so there are obviously some very, very heated areas. A general observation I've been making for a few years now, even before COVID, is that if you look at you know international markets as a whole, what we've generally seen is that by most metrics, U.S. equities were rather expensive compared to international equities. However, international real estate was rather expensive compared to U.S. real estate. Maybe the exception of Manhattan and San Francisco and a couple key cities. Basically, suburban U.S. real estate has generally been rather reasonably priced compared to the broad, the world for quite a while. And so we've seen that kind of arbitrage in the recent year where a lot of people poured into those suburbs and kind of bid up those prices. And so now I would be more concerned about valuations, and especially with say a 1 to 2 year view, just because we pulled forward so much demand in a short period of time. But I do think it's very zip code dependent, and so of course there are still suburbs in maybe some of the areas that are a little bit less hot that actually still have rather reasonable valuations compared to some of the other investments out there.
All right, thank you. Do you offer a discount for Money Show viewers for your premium service?
I don't, but I keep the overall cost of that really low compared to the amount of content that's published in there. So my overall approach there is, kind of like how there's retailers that they're always doing discounts and other ones just kind of, maintain really aggressive, kind of attractive prices all the time. I go with that approach where I don't really do discounts, but I keep the overall price level really competitive.
Are there any value stocks you recommend people taking a look at?
So value stocks, again, I like Bristol Myers Squibb, as part of a diversified portfolio. I also like Enterprise Products Partners, for example. It's one of the better managed MLPs that are out there. I also like EOG Resources, for example, in the oil space. And I like, say, the Bank of Nova Scotia in Canada, kind of one of their large banks, trades at slightly below average valuations, and has some exposure to Latin America for growth. It also gives them some volatility, but it's basically a bank that gives you both Canadian and Latin American exposure. And so I think there's a lot of equities like that out there that are offering pretty compelling valuations.
Thank you. Any thoughts on XLE and OIH?
So I do think I don't follow OIH that much. I like XLE. Obviously, it's very heavily weighted towards the majors. There's also some of the transportation companies, like the pipeline companies in there. Another ETF that I actually like is IXC, which is the iShares Global Energy ETF. And so basically, if you want to spread out your jurisdictional risk and if you want to have less concentration in Chevron and Exxon, I like IXC, and so that'll give you those big, pretty much everything in XLE, but then you also have some of the European majors, you'll have some of the Russian majors, you'll have basically a little bit more globally diversified energy exposure. And so I actually like that one quite a bit.
Thank you. Do you see a market pullback soon? And how about gold?
So gold's been tricky. It mainly follows real interest rates, and so it peaked in August 2020. Then it went through an 8-month correction, and I've been tracking a bottom since March. And so I kind of started pounding the table on it again back in March, and we've had this nice little run. I wouldn't be surprised to see that consolidate a little bit, but I remain rather bullish on gold, with a 12-month perspective. For broader markets, it's really, I think, partially going to depend on some of these headlines around fiscal stimulus. And so, part of why the equity market's done so well, actually, the major part is all this fiscal stimulus kind of poured into the economy and propped everything up. And so, basically, kind of the risk to markets now is that they've gotten so high on all these shots of adrenaline, and that if those shots stop coming, you could see it roll over, in the second half of this year. And so I do think there is a significant risk of at least a consolidation, if not a correction in broad markets. But that's again why I prefer to focus on names like Bristol Myers Squibb here compared to Cadence, because if someone's asking me to judge what this is going to do, it's very sentiment dependent. I mean, it doesn't pay a dividend. It's trading at over 40 times earnings. And so the market could just wake up and decide that they'd rather pay 30 times earnings for that stock, right? So that's one of those things where that's a big risk factor. Whereas Bristol Myers Squibb, it pays you to own it, so you're getting 3% yield. You're holding it at like 10 times earnings, and so you still have to monitor its fundamental health. But overall, I prefer equities where I can do, say, a discounted cash flow analysis and decide that they are attractively priced.
All right. Well, thank you very much for your time today. That was a fantastic presentation.
Yeah, thanks so much for having me, and thanks for everyone for